Hello, my TFA friends. We have been together for quite some time, my friends. Hopefully, you are still enjoying this. We are nearing, of course, the end of the economics master classes, but I am still gonna need you to pay attention for just a little bit longer. My little stick man here also wants to learn economics. He's told me he'll be putting more than 300 hours of study time towards his level 1 exam. Okay, so let's get started. So here we're looking at capital flows and the FX market. So hopefully you're gonna be all excited about FX and exchange rates. Okay, right. So here we've got FX quotes. We're gonna learn about direct and indirect quotes. We're going to learn about nominal versus real exchange rate. So nominal, of course, is measured in paper money terms and real is measured in apples, pears, and goods and services terms. Direct and indirect quotes. This is where we're going to be looking at whether the domestic or the foreign currency stays in the numerator. And finally, we're going to also look at your trade balance. So we're going to look at current account surplus and deficit, capital account surplus and deficit, and also the interplay of savings, private investment, taxation, and government spending. All very, very exciting stuff. Okay, now the first thing we're going to start with in terms of warm-up is our currency pairs here. So as you can see, currency pairs are quoted to 4 decimal places. That's generally true for most currencies except the yen, which is going to be quoted to 2 decimal places. So any pair involving the yen will be quoted to 2 decimal places, but most other pairs will be quoted to 4 decimal places. And here we have GBP over USD. So that means that the pound here is our numerator currency and the dollar is our denominator currency. Or we also like to say this is the price currency, whereas this here is the base currency. And if this confuses you, always remember the base currency is the 1 unit. So in this case, we're saying that the 1 unit of dollars, the denominator of the base currency, $1 will buy me 0.5440 pounds, just over 54 pence in that case. Okay, so just remember GBP /USD. The pound is our numerator, the dollar is our denominator, and we are quoting to 4 decimal places. Now, you should also probably know that the last decimal place here is known as the pip or the point, and that's going to become more important when we're measuring spreads later. Now, we're also going to talk here about nominal and real exchange rates. So nominal would be this number here. So this is essentially just measuring the exchange rate between the two currencies in nominal terms. Remember, nominal means that we are including any impact from inflation. So we are measuring the currency value in paper money terms, in fiat terms, okay? Now, sometimes we may want to strip away the impact of inflation or the impact of the price index, in which case we are referring to this as a real exchange rate. And of course, movements in the real exchange rates are going to tell me whether I'm gaining or losing purchasing power in real terms. So am I actually able to buy more goods and services from the foreigner vis-a-vis last year? And is the foreigner able to buy more or less goods and services from me in real terms vis-a-vis last year? So we're going to calculate the real exchange rate. And remember here, we're always looking at price over base. So price is just your numerator currency, base is just your denominator. So it's always going to be price over base. How are we going to do this? We're going to take our price over base nominal exchange rate, and then we're going to multiply by the ratio of the two CPIs. Of course, CPI stands for Consumer Price Index. The only thing that you got to remember here is that the CPIs are reciprocated. The CPI for the base currency, i.e. the one that's in the denominator for the exchange rate, the CPI for that currency is now in the numerator. The CPI for the numerator currency is now in the denominator. Now you might be thinking, why is that happening? Well, that's happening because we want to strip away the impact from inflation. So by reciprocating the CPIs, we're kind of canceling out the inflation impact that is contained within the nominal exchange rate. Okay, so let's get into a little example then. Okay, we're gonna work out here the real exchange rate. So I'll assume that the nominal exchange rate GBP / euro, so GBP per euro increases by 11%. So that's our nominal going up by 11%. Eurozone price level increases by 6%. And UK price level increases by 3%. Calculate the change in the real exchange rate described by UK individuals' purchasing power relative to purchasing Eurozone goods. Okay, and here the slide does kind of give you a little hint as to how you might want to approach this problem. So now the percentage change in our real exchange rate. Now this is the actual geometric computation. This will be the accurate computation. We'll take 1 plus the nominal exchange rate, so the growth in the nominal exchange rate. And by the way, here we're always focusing on the base currency. Okay, so whenever we're doing a problem involving exchange rates, I often get asked, what is it, which currency are we really calculating the premium on, the discount, the growth, etc. It's always gonna be the base, my friends, the base, okay? So what we're gonna do here is we're gonna take 1 plus 11, so that's gonna be the growth in the euro in nominal terms. So I'm gonna go 1 plus 11, so the euro appreciated versus the pound by 11% in nominal terms. Now here, just like I saw on the previous slide, if I was looking at the nominal exchange rate to strip away inflation, I would have to reciprocate the CPIs. So here I'm going to basically just do the same, but I'm going to reciprocate the growth rates of the CPIs. So remember, GBP, maybe even write it somewhere, GBP over euro, okay? So that's my price and that is my base. So I want to multiply by the growth rate in the base, okay? So I know that the base is euro, so Eurozone price level increases by 6%, so I'm going to add 106 to my numerator, and I will add 103 to my denominator. Then I will have to knock off the famous 1, and you can do this on your calculators, my friends. It will give you 14.23, 14.23%. And again, that is calculated with respect to euro. So the euro appreciated by roughly 14% in real terms. And in a minute, I'll tell you what that actually means. But just before we do that, there is an approximate solution. So if you don't like compounding like that, the approximate solution is to say that the euro appreciated by 11% in nominal terms. Now then also the Eurozone goods became 6% more expensive, so we're going to be adding 6% to that number to get 17. And then we're going to offset that against the increase in the UK price level of 3%. So 17 minus 3, of course, will be 14%, which will be approximately correct, right? Because the correct answer was 14.23. Okay, so now back to the question, what does that mean? What does it mean for the euro to have appreciated by 14% in real terms? Well, it means that a UK consumer can now buy 14% fewer goods and services from EU countries. Okay? Let me say that one more time because it's so important. The euro has appreciated by 14% in real terms. So a consumer based in London, United Kingdom, okay, or I don't know, Cardiff, Wales, or Belfast, Ireland, or Edinburgh, Scotland. So a consumer based in these cities will be only able to buy 14% fewer EU goods and services, my friends. Okay, let's have a look at this one. And of course, you know what you gotta do. A decrease in the real exchange rate, quoted in terms of domestic currency per unit of foreign currency. So notice here, we are quoting DC over FC. So that's, of course, a bit arbitrary, right? So you're going to know which currency is domestic from your point of view. Now, I've got a lot of viewers from America, so for you guys are going to be the dollar. Obviously, I'm going to have viewers from the UK, so the pound, from Eurozone, the euro, and many, many other countries as well. So it's arbitrary, and that's why I normally don't recommend students solve problems by thinking about domestic and foreign. But sometimes questions are worded that way, and you have to sort of play by the rules of the game. So here you've got domestic over foreign. And we need to figure out basically what will cause a decrease in the real, right? We need to figure out what will cause a decrease in the real. Notice here we have an increase in which of the following. Is it the foreign price level, domestic price level, the nominal exchange rate? So to solve this, of course, you need to remember here that we are taking the CPI of the base currency, in this case FC, the foreign currency, we're going to be dividing by the CPI of the numerator, which is the DC, and that's going to give me the real FX. Okay, and as per the question, I want the real FX to drop. So now will an increase in the nominal exchange rate, right? Will an increase in the nominal exchange rate cause a drop in the real FX? Of course not. So that doesn't make any sense at all. Boom, easy win there. That can't be right. Now let's look at increase in CPI for the foreign currency. If that went up, well, that's multiplied by the nominal exchange rate, and it is in the numerator, so it's going to cause an increase in the real FX, so that can't be right either. So of course we know this is right. Domestic price level has to go up, and that here is our denominator, so it's bringing the answer down. Okay, so we've talked about what's domestic and foreign. Now let's talk about different types of quotation systems. The first system is known as the direct. So direct quotation is where you have DC over FC. So domestic over foreign. So as I've already told you, I'm based in London, United Kingdom. So for me, it's gonna be pound over dollar. That's basically, from my point of view, a direct quote for this particular exchange rate. Now, if I wanted this quoted indirectly, then I want foreign currency in the numerator and domestic currency in the denominator. So for me, the dollar is the foreign. So it's going to be dollar over pound. From my point of view, that'll be an indirect quote. Now, if you were based in America, of course, the whole argument reverses, because of course for you the pound is the foreign currency. So I told you this is a little bit subjective, and when we get to things like the interest rate parity, I will be definitely telling you, try not to think in terms of foreign and domestic, because this will probably confuse you. It's much better to think in terms of numerator and denominator, or price and base, and we're going to talk about that in due course. But for this particular slide, of course, you will need to know which one is considered domestic. Put it in the numerator. So the kind of little tip I will give you here, at least that's how I try to remember it, is domestic starts with the letter D. So I'm putting that in the numerator for the direct quote. That's how I've always remembered it. Domestic numerator gives me direct quote, and then work the rest out from there. All right, so I've got a dealer. My dealer is based in New York City and provides a spot exchange rate quote of 18 spot 8590 Mexican peso to USD, right? Mexican per USD. Notice how we're quoting to 4 decimal places to a client in Mexico City. Okay, the inverse of 18 spot 8590 is spot 0530. Okay, and you can check this on your calculator. If you do 1 over that number, 1 over 18, spot 859, you will get spot 0530. So that's the inverse. Now, from the perspective of the Mexican client, now obviously the Mexican client considers the Mexican peso to be the domestic currency. The most accurate statement is what? Direct exchange rate is spot 0530. Well, that'll be the inverse of MXN over USD. So this is USD over MXN. Or in the case of our Mexican friend here, that is foreign currency because he's Mexican over domestic currency. And that is an indirect quote. Boom. So that's not right, my friends. Direct exchange rate of 18,8590, which is the number that was given originally. So that's MXN over USD, which for our Mexican friend is domestic currency numerator over foreign currency. And that is a direct quote from the point of view of a Mexican trader. So Bravo has to be a winner. And just a rule out, Charla, indirect exchange rate quotation is equal to 18,859. Oh, well, that's just the opposite of Brava, so they can't both be right. It's not indirect for the Mexican investor because indirect would be foreign, i.e. USD numerator over MXN in the denominator. So pretty straightforward question. I don't want to really dwell on it too long. Okay, now bid ask spread. Okay, so we also need to be able to think here about the way market makers operate. So remember, a market maker buys and sells currencies. Yeah, currency pairs, really. They're providing quotes on currency pairs. So when they provide these quotes, they provide you with a bid quote and an ask quote. The bid is the price at which the market maker buys the base. Again, here, please underline the base. It's all about the base, my friends. It's all about the base. So the market maker buys the base at the bid and sells, you guessed it, the base at the ask. Now, the ask is also known as the offer price. Okay, so you could say bid ask or you bid offer. Very, very important. The ask is always greater than the bid. Now, that should be a pretty obvious statement because remember, the basic financial mantra that I preach 24/7 to my students. If you want to stay in finance, what you gotta do? You gotta buy low and you gotta sell high. Your basic 101 financial mantra: buy low, sell high. So what kind of dealer would stay in the market if he bought high and then sold low? Yeah, they're not gonna stay in market very long. So the bid is always smaller than the ask. The ask is always greater than the bid. Buy low, sell high. That's from the point of view of our market maker. Okay, so here I've got an example. Swiss franc per €1. So identify the base. Euro is the base. So remember, as per Martin's advice, you are trading the base. Ignore the numerator. Don't worry about the numerator. You are trading the base. Or in this case, the market maker is trading the base. Okay, so the market maker buys euros at this first price. Okay, so the market maker buys euros at 1.1483 and sells euros at 1.1485. Notice how the second quote is higher than the first quote by spot treble 02, which is actually equivalent to what's known as 2 pips or 2 points, and that is the spread. And that's basically the commission they're charging you, the profit they're making on each trade. Now, the actual prices are in CHF. That's why CHF here is referred to as the price or the quoted currency. But what the market maker's actually buying and selling is the euro. And that's why I want you to keep thinking about the euro. Keep thinking about the base, not the, I was going to say not the treble for some reason, but actually I wanted to say not the numerator currency. Okay, so you're buying the base. Okay, so that's from the point of view of the market maker. How about if Martin here comes and wants to buy euro? I'm not the market maker. I'm just in the airport going on holiday to a lovely Greek island. Okay? And of course, Greek islands do use the euro. So I need to buy the euro. Okay, which price am I gonna get here? Well, if you guessed the ask, you guessed right, my friends. Okay, so someone who trades with the market maker will get the worst of the two prices. So I will buy euro at the higher price. And also, if I had to sell euro, I will have to sell it at the lower price. So while the market maker is making commissions every time you trade, you're actually losing mana every time you trade, right? Because you have to pay commissions to the market maker. All right, bid-ask spread example. If the bid offer quote from the dealer was 18 spot 858-18 spot 86 Mexican $2, then the bid offer quote in USD over Mexican would be closest to. Okay, so this problem essentially asks us to reciprocate the pair. And of course, we can do this computationally using the 1 over X button on our Texas Instrument BA2 Plus or Professional. And we can do that in a minute. But I also want to remind people that often you can solve problems by inspection. You don't necessarily always have to compute. So for example, in this question, I noticed that once reciprocated, for some reason, they put the bid being higher than the ask. Well, that, as I told you, is not gonna keep the market maker in business for very long, right? The bid cannot be greater than the ask. This is simply mathematically impossible. Okay, so Bravo can be correct. Also notice that Charla seems to suggest that both the bid and the ask are the same number. Well, there's no reason to believe they will be the same number. A, the bid and ask before reciprocation were not the same number, so that doesn't make any sense. But B, also, what kind of market maker would simply offer bid and ask without charging any commission, right? I mean, they're not going to work for free. They also have to pay their bills. So Charles is wrong. Alpha is correct by inspection. But now let's go ahead and do the computation. And here you got to remember something. Remember, guys, I teach a lot of level 2. And I know that this becomes a bit of an issue for some of the level 2 computations we got to do. So I always remind my students, when you reciprocate the new bid is 1 over the old ask. And the new ask is 1 over the old bid. And now you might think, wow, this is probably not going to be something that I will remember. Guys, remember, why is this happening? It's happening because the bid has to be lower than the ask. So the new bid has to be lower than the new ask. So you have to divide 1 by the greater number, i.e. 1 by the ask. So in our case, that'll be 1 over 1886, and this will be 1 over 18858. And this, of course, will give us, hopefully, the answers from option alpha. Okay, but you're most welcome to try this on your calculator. Now I know this will give us the right answer because that is the only possible answer for this question. Okay, the new bid has to be lower than the new ask. Okay, now let's have a look also at HPR, the holding period returns, or how we're going to calculate the movement in an exchange rate. I've got USD per GBP, and that exchange rate has gone down from $1.61 to $1.59. Okay, so here we need to first of all think about which one is our base currency, which is the pound. Okay, so now the price of a pound, which is measured in dollars, has gone down. So we say that the pound has depreciated. Now remember, when we are calculating holding period return on anything really, we just take P1 over P0 minus 1, right? The closing price over the opening price minus 1, and that is a holding period return. So what is the HPR on the pound? The rule here is if you're calculating the HPR on the pound, you must ensure that the pound is your base currency. And yes, it is. So we can directly use these numbers here. So P1 in our case is the final price. P0 is our starting price. So the answer will be 159 over 161 minus 1. And that is how we can calculate the depreciation in the pound, and that is 124. So the pound has depreciated by 1.24%. Now, of course, that means that if the pound's depreciated, then the dollar must have appreciated. And to do that, we will have to reciprocate. So we need to make sure that the dollar is now our denominator currency. Now, you might be thinking, wait a minute, Martin, isn't that gonna be a necessary calculation? Can we not just simply say, well, if the pound has gone down by 124%, it follows that the dollar has gone up by maybe 124%, right? Maybe you're thinking that's what's going to happen. Unfortunately, my friends, the nature of percentages means that it's not going to be a mirror image. So it's not going to be plus minus the same percentage point, as we shall discover. So let's do the calculation. First of all, I'll show you the long calculation, and then I'll show you a potential trick. So our P0 is our starting currency, but now we need to make sure that it is expressed in pounds per dollar. We need to make sure that the dollar is our base because we're calculating the HPR on the dollar. So it's going to be 1 over 161. And let's quote this to 4 decimal places, which is spot 6211. And our P1 is going to be 1 over 159. And let's quote that to 4 decimal places as well, which is 6289. Okay, so our HPR here would be 6289 over 6211, knock off 1, and that's going to give us plus 126. So as you can see, very similar to minus 124, but not exactly the same. Not exactly the same. So our GBP price of a USD has gone up by 126% is the right answer here. Or maybe what we could have done, is we could have written this down here. So let's just move it here. Okay. So that's basically the long way of doing the calculation. Now, Martin's got it covered. Because I've got a little trick for you, my friends. And so here's our calculator. And I'll show you how you can quickly convert this number, the 124 to the 126. So this is what you got to do. So you're going to go 1 minus 124. 124. And then you will simply hit the 1 over x button and minus 1. And you can see here you will get the 126. Or you can also convert the 126 really quickly to 124 by saying 1 plus 126, right? Then reciprocate that, minus 1, and boom, you've got 124. Brilliant. So I love this trick, especially if the pairs are not quoted the way I like them to be quoted. I just go ahead and calculate the HPR the way they're quoted. So for example, the original question, the bias is the pound. So I'm going to calculate the HPR on the pound. Once I've got the HPR on the pound, I'm just going to use my little trick here to calculate the HPR on the dollar, if that's what they're asking, right? All right, now exchange rates and trade balance. Now here we're going to look at some macroeconomics. So let's first of all demystify what's going on in this equation. So what they're basically saying that net exports, so there you've got net exports, X minus M, which may be referred to as your trade balance. Or you know, trade surplus, trade deficit, trade balance. Sometimes we could talk about current account surplus, current account deficit. So that's kind of what's on the left-hand side. And they're saying this is going to be equal to open close bracket savings minus investments plus open close bracket tax revenue minus government spending. Okay, so let's try to kind of intuit what's going on here. All right, so what does it mean, first of all, to have a current account surplus or a trade surplus? It means that you're exporting more than you are importing. So you're selling goods and services to the foreigner, but the foreigner is not buying as many goods and services from you. So essentially, you are earning more money than what you're spending, right? So just think at a household level. If your salary was greater than your monthly expenditure, you're going to have some money left over at the end of the month. And what can you do with that money? You can potentially save it. Okay, so what they're saying is, when you've got a trade surplus, and trade surplus would be X greater than M. Now, remember that's you earning more money than what you're spending. Now you can save. So the first bracket here, savings minus investment, is referring to your private savings. So you may have private savings, which essentially means that your savings exceed your investments. And here, if you watch the fiscal policy video, that should be quite easy. Fiscal policy, remember, was the interplay between taxation and government spending. Taxes is what's coming into the government's coffers, and government spending is what's coming out. Right? So if my taxes are greater than my government spending, then I'm essentially a government saver, and these are government savings. So we're basically saying a very simple thing. If I'm running a trade surplus, if I'm exporting more than I'm importing, I'm a saver. So I'm either going to have private savings and or government savings. Okay? Private savings and or government savings. So if I'm running a trade surplus, what am I going to do with these savings, my friends? What am I going to do with the savings? I must either lend them to the foreigner I must either lend them to the foreigner or I must buy assets from the foreigner. Okay, very, very important. I either lend to the foreigner or I buy assets from the foreigner. Now that's going to result in a capital account deficit. That means I am a net investor into the foreigner's country. Okay, so this is quite easy to remember. If you have a current account surplus, also known as a trade surplus, if I have a current account surplus, I'm going to have a capital account deficit to balance this thing out, right? Because trade surplus means that I'm exporting more than I'm importing, I'm earning more than I'm spending. Now I'm a saver. What am I going to do with this savings? Am I going to lend them to the foreigner or am I going to buy assets from the foreigner? And that's going to result in a capital account deficit. Okay, now this slide isn't easy. So that's why we're spending so much time. And also I'm going to reverse it now. Let's suppose I was running a trade deficit. Let's suppose I was importing a lot more than I'm exporting. Or if I want to use the household analogy, I am spending more than I'm earning. Now, you all know what's going to happen if you're spending more than you're earning, right? You're going to have to borrow. You're going to have to borrow. Money has to come into your country. So a trade deficit is going to be associated with the capital account surplus. So now in terms of the equation, if the left-hand side is negative because we were running a trade deficit, then the right-hand side must be negative as well. So this time maybe your savings are not sufficient to cover investments and or you are running a fiscal deficit, right? Remember, fiscal deficit is when government spending is greater than tax revenue, so the government is borrowing. All right, so if we basically reverse our logic, now we can say if I'm running a trade deficit, it means the foreigners are lending to us or we are selling our assets to the foreigners. Okay, let's have a look at this question then. A country with a trade deficit. Now, there's a big hint here. Country with a trade deficit. So a current account deficit. That means that exports are lower than imports. We're importing more than we're exporting. We're spending more than we're earning. We'll have an offsetting capital account surplus. So if I'm borrowing, that means foreigners are lending to me. That means I'm selling me assets to the foreigner. That means that I am running a capital account surplus. Money is coming into the economy, right? Investments are coming into the economy. So that's going to be our correct answer, but let's just rule out Bravo and Charlie. So save enough to fund investment spending. Well, if you go back here, you would want S to be greater than I, right? You would want a positive number on the right-hand side, most likely when you have a positive number on the left-hand side. So when you're running a trade surplus, but when you're running a trade deficit, you've got a negative number on the left-hand side, so you're going to probably want the negative number on the right-hand side. So you're going to want your investments to exceed your savings. So that doesn't sound right. And then buy assets from foreigners to find the imbalance. Well, remember, if you're running a trade surplus, you're going to be lending to the foreigner or buying their assets. But here we're running a trade deficit, so they're going to be lending us. And we are going to be selling our assets to the foreigners. So that's also not going to be the right answer. All right, my friends, thanks for watching and have a great day.